60 minutes. That's all it took. Just 1 hour for one of the most brutal market meltdowns in recent memory. You know, if you follow gold and silver, what went down on January 29th was a complete and utter shock to the system. So in this explainer, we're going to break down exactly what happened, the hidden forces that were really pulling the strings, and what the pros are watching right this minute. All right, let's get into it. To really wrap your head around just how violent this was, you have to start with this number, $6 trillion. That's not a dip, folks, that's a crater. It was a tidal wave of selling that just vaporized fortunes, poof, in an instant. It was a financial earthquake, and the aftershocks left everyone just kind of looking around asking, what in the world just hit us?
And you know, this quote from the wealth historian just nails it. This wasn't just numbers flashing on a screen. No, this was a painful, brutal wake-up call for so many traders who got caught up in the hype, thinking the rally would just go on forever. So let's go back to the scene of the crime and piece this puzzle together.
Okay, so to really understand what happened, we've got to start with the timeline, because the speed, the incredible, terrifying speed of this collapse is a massive part of the story.
Just look at how fast this all went down. At 10:30 in the morning, everything's fine. The party is still in full swing. But just 1 hour later, 1 hour, the floor completely gives out from under the market. This wasn't a slow leak, it was a sudden, violent chain reaction. Margin calls triggered forced selling, which of course created prices, which then triggered even more margin calls. It was a death spiral that sent silver to its worst single day since that infamous Hunt Brothers crash way back in 1980.
So the huge question is, why? What caused this? A sell-off this vicious doesn't just happen out of the blue. There were signs, you know? A perfect storm of factors that basically lit the fuse on this powder keg.
It was really a combination of three major forces all hitting at once. First off, the Federal Reserve started dropping hints that it was going to keep interest rates higher for longer. Well, that makes holding US dollars a lot more attractive than holding a metal that pays you zero interest. Second, you had some weak economic data trickling out of China, which sparked fears of lower industrial demand for silver. And third, with the US government shutdown deadline right around the corner, traders sitting on huge profits had the perfect excuse to just say, you know what, I'm taking my money and running.
Now, those first 2 points lead us to the single most important thing that professionals live and die by, but that so many retail traders completely ignore, the DXY, or the US dollar index. See, here's the thing. Retail traders often get caught up in the story of gold, you know, inflation, crisis, all that. But the pros, they're watching the markets plumbing, and the DXY is the main pipeline. On the day of the crash, it absolutely exploded higher.
And this is the perfect way to think about it. It's just a simple seesaw. You've got the US dollar on one side, and you've got precious metals on the other. Because gold and silver are priced in dollars, right? So a stronger dollar means it takes fewer of them to buy an ounce of metal, which pushes the price down. The pros saw that dollar spiking and were hammering the sell button long before most people even saw the first big red candle show up on their charts. But here's where our whole mystery takes another sharp turn. Right after this historic demolition, something really weird happened. The market didn't just keep falling off a cliff, it bounced, and it bounced hard. And we're not talking about a little blip here. The numbers were huge. Silver futures shot up almost 13%, with gold jumping nearly 6%. Now, if you just got totally wiped out, you're just confused. And if you're sitting on the sidelines with cash, you're asking the same urgent question. Is the worst over, or is this whole thing some kind of trap? Well, the skeptics see a couple of potential traps here. The first one is a classic bull trap. This is where a really sharp rebound happens on low volume, and it sucks in all the hopeful buyers, making them think, okay, the bottom is in. classic flashing red warning sign. They're saying this parabolic rise followed by a vertical crash is a textbook market top, just like the market in 2011. They think the momentum is just plain broken, especially with exchanges jacking up margin requirements. So we've got two completely opposite takes from very smart people. How in the world are you supposed to make sense of it all? Well, the professionals are doing their best to ignore all the noise and are laser focused on just a few key data points.
Here's what's on their radar. First and foremost, the DXY. I can't say it enough. If the dollar stays strong or gets even stronger, that's a major headwind for metals, period. Second, they're listening to the language from Fed officials. Do they sound hawkish or dovish? Their tone moves markets. Third, we've got key economic data like the US jobs reports. And finally, the charts themselves. Can silver stay above its critical 9-week moving average? And does